Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Trahan, and this month we're speaking with HSBC's Chief Economist for Australia and New Zealand, Paul Bloxham. Thanks for joining us today, Paul.
No problem.
The RBA named China's property market as a key risk for the Australian economy. Why is this so?
Well, China is seeing a downturn in its property sector at the moment, and China is Australia's largest trading partner. It's the largest source of demand for commodities, and that's why it's a worry for Australia. The downturn in China's property market is seeing less demand for steel, which is one of the contributing factors to lower iron ore prices and lower coal prices. So this is something that we really need to be watching very carefully, and the RBA is watching it very carefully. One of the things to keep in mind, though, about the Chinese property sector is it is subject to very large and frequent cycles. This is the third time we've seen house prices falling in China in the past 6 years alone. So they rose and they fall and they've risen and they've fallen. And this is the third time that we've seen it happen. So there is a property sector downturn going on in China at the moment, but this is not an unfamiliar occurrence. The question is this one going to be bigger than the previous ones? Is it going to see more of a downswing in demand than the previous ones and put more pressure on those commodity prices? And that's the main thing the RBA is watching. I guess the other thing that they're potentially concerned about is, as the property sector sees a downturn in China, does this see any risks to financial stability in China? Because that could make this an even more problematic event. At the moment, the RBA's view, and actually HSBC's view as well, is the Chinese will get their target of 7.5% growth this year, and we think we're going to see a similar sort of growth rate as you look into 2015. We do think that the property sector is unlikely to drag the Chinese economy down substantially.
What is the overall outlook for the Australian jobs market?
Well, the labour market's quite loose in Australia at the moment. If you step back and look at what's been happening for Australian growth, back in 2011 and 2012 we had exceptionally strong growth in the mining and mining investment. The mining story was the key driver of growth. Since then, we've needed the other parts of the economy to start to pick up. We need growth to rebalance, to shift to being led by the non-mining sectors of the economy. Now, to achieve that, the RBA has got its cash rate now at its lowest level in history, and it's been there since August of last year. And mortgage rates are at very low levels as well, and they're trying to support growth in the non-mining sectors of the economy. There are some signs that that's happening. The housing market is booming, there's a pickup in residential construction. There hasn't, however, been much of a pickup in investment in most of the non-mining sectors outside of housing. So that transition, that rebalancing of growth has been slow, it's been sluggish. And because it's been slow, it hasn't been creating a lot of jobs. It hasn't been creating enough jobs to soak up all of the new population growth we've got, so the unemployment rate has been gradually climbing. So for the moment, the labour market is loose. If you look further forward, though, we are seeing some signs that the labour market is starting to stabilise. We do expect that that rebalancing of growth will continue into 2015, and we think we'll see the labour market start to tighten up as you look through 2015.
How is Australia's retail market performing currently?
Well, the retail numbers are a reflection of that rebalancing story as well, in the sense that retail sales had been quite weak while the mining boom was going on. Interest rates were quite high, the Aussie dollar was high, was encouraging people to be spending a lot more offshore. But low interest rates now, we've got mortgage rates at their lowest level in over 50 years. A booming housing market are supporting a bit of a pickup in retail sales. They're running at just under 6% at the moment. That's higher than they were through most of last year. And we think that retail story is going to continue to get support, particularly from low interest rates. And also from the fact that, of course, there's been an upswing in residential construction. So as people build more houses, they need to fill them with more durable goods. So we think household goods sales will continue to pick up fairly solidly. There are already signs that that's happening, but we think that into 2015 the retail environment will continue to improve.
How is the rest of Asia coping with the slowdown in growth for China?
Well, it's a challenge because the rest of Asia is somewhat dependent and fairly highly dependent on trade with China. So the fact that China's economy is not growing as quickly as it used to is something that the rest of Asia is having to deal with. In response to that slower growth in trade, we've continued to see a ramp up in leverage in Asia. The Asian economies are driving themselves by continuing to leverage up, continuing to see an increase in bank lending. And so that's been one of the key drivers of growth rather than productivity growth in Asia.
What about the global impact of China's growth slowing?
Well, China is the second largest economy in the world, and so it is having an impact on the global story. Now, it's worth keeping in mind, and it's very important to keep in mind, that although we talk about China slowing down, and it's slowed down, it's not running at double-digit rates anymore. Growth is not 10%. This year we think it'll be 7.5%. Next year we think it'll be around about a similar sort of rate. It's not growing at those double-digit rates. But because China is a much larger economy than it used to be, because over the past 6 years it's grown by 65%, it's more than half again as big as it was 6 years ago.
Which other economies in Asia do you expect to perform strongly over the coming 12 months?
Well, if we're looking at what's happening in Asia at the moment, one of the key developments over this year has been changes of government in both India and Indonesia. And both of those changes have been more towards reformist governments. In India, we had the election of Narendra Modi in May of this year, and this is sort of the biggest shift in Indian politics we'd seen since the mid-1980s. It was a big swing. Now, one of the big things that have been constraining India's growth had been lack of infrastructure and the political environment. The change of government is likely to be a catalyst for a shift, and particularly a shift in terms of investment in infrastructure. So we're more positive on the Indian economy since the change of government. We do see Indian growth lifting as you look into 2015. And as I said, Indonesia has also seen a change of government, again towards a government that seems as though it's likely to be fairly reformist. And if that's the case, we expect Indonesia's growth to also lift. So I think those are two countries that we're watching very carefully, particularly for 2015.
The European Commission has said the eurozone economy will grow by just 0.8% this year. What has caused that poor growth?
Europe's got some very large challenges. One of the key challenges, of course, is that those 18 countries that are in the euro, that have the euro, have got all the same currency, and so any shocks that hit the European economy as a whole have to be dealt with in a similar sort of way in each of those economies. They haven't got currencies that adjust to be able to allow those economies to individually adjust. That's not happening. So the common currency, I think, is one of the key challenges that Europe faces, and that's one that they're going to continue to face. The other, of course, is as a consequence of very weak conditions. Over the past 6 years, Europe has not grown. Europe hasn't grown. Europe is actually a 2% smaller economy than it was 6 years ago, even at this point in time. Now that compares with the US, which is 7% larger than it was 6 years ago. Even though they had the global financial crisis, Europe was also struck by the European financial crisis. As a consequence, of course, of that weak growth, their debt levels have also risen as a proportion of their economy. So one of the other challenges that Europe faces is debt is constraining their ability to grow. So it's very hard to see Europe picking up particularly strongly anytime soon. Growth is likely to continue to be fairly lackluster. One of the things that could provide a stopgap, a valve for Europe, could be a lower euro. We do expect the US dollar to appreciate and the euro to come down, and that could help to try and support growth in Europe. But I don't think we should be expecting strong growth in Europe anytime soon.
When can we expect the eurozone to start posting more impressive annual growth figures?
I don't think it's going to be within the next few years. I think we're going to see Europe continue to struggle. They've got a lot of challenges, as we talked about. The idea that they've all got one currency, the fact that the governments have all got fairly high levels of debt, the fact that governments are seemingly unwilling to do much fiscal spending. The thing that can really help them out to a large degree would be a strong US economy. But Europe is still operating at well below capacity. Its unemployment rate is still 11.5%. And so there's a long way to go in terms of before Europe is likely to see stronger growth rates.
Which economies in the eurozone are underperforming in particular?
Well, what's most frightening about the most recent developments is that Germany is the one that's actually slowed down a lot recently. Since the global financial crisis began, you could look at Germany and say that was the stronger amongst the European economies. A lot of the peripheral nations did very poorly, and indeed they're stabilising, but they're still not doing particularly well. But now the core, the German economy, is also slowing down. So one of the key challenges that Europe faces is the core driver of its growth, the German economy, is also slowing down. And that's one of the reasons we've seen weaker conditions in Europe overall recently.
What is the overall progress of the US economy?
Well, we think the US economy is on a modest road to recovery. That is, if you look back since the global financial crisis began, it saw a massive contraction, and since then it's been gradually recovering. We don't think it's going to race away anytime soon. We think growth is gradually picking up in the US. You're seeing that reflected in the labour market, you're seeing it reflected in the manufacturing industry, and you're seeing it reflected in policy as well. The Federal Reserve has ended its quantitative easing program. We expect that by the middle of next year we'll be seeing the Federal Reserve start to lift interest rates. base as well. So the US economy is on a gradual road to recovery, and that's a positive thing for the global economy. It is an economy that can help to support overall global growth. A stronger US dollar as a consequence of a lift in the US economy is likely to be a positive thing, because it would, of course, see weaker currencies elsewhere, which would add to the competitiveness of the other economies.
We've seen an uplift in the US jobs market. How is that likely to impact the rest of the economy?
Well, the jobs market is improving. You're seeing it gradually improve as the rest of the economy has been on this modest road to recovery. There are jobs being created in the US. The challenge is that at the moment, even though jobs are being created, wages growth is still quite low. It's below average. And as a consequence, inflation is still below its average. Now, it seems as though the US has gotten rid of the threat of deflation, a challenge that the Europeans still possibly face as we look into 2015. But the US economy is still operating with inflation that's well below its target. So a tighter labour market is still needed in order to see an upward pressure on wages and a consequent upward pressure on inflation. But the labour market is gradually healing.
What about the strength of the US dollar and its outlook?
Well, we think the US dollar is likely to appreciate further. In fact, we've been asking the somewhat rhetorical question, can the US dollar save the world? Can an appreciation of the US dollar provide enough support in the form of lower currencies in other countries, as well as stronger demand in the US economy, to lift the rest of the world out of its slower growth path? Can it in particular support Europe? Could it support Japan, where you've seen quite a large depreciation of the yen and the US dollar is obviously appreciating? Now, it's not clear that it can necessarily save the world, that the US is going to be the powerhouse that it used to be in terms of driving global trade, but it's certainly going to help. And it's certainly going to help, in particular, Europe, which is mired in high levels of debt, the constraint of a single currency, and the threat, and where the threat of deflation is very clear. So I think a stronger US dollar is going to be quite helpful for the global economy.
Thanks for joining us today, Paul.
Thank you very much.